our first session, and can we have the slide up, please, is Quant for family offices and advisors. Now, as you will, hang on, I think I can do this. Oh, we have just this one. Do we have the speaker slides up? Yeah. But let me introduce to you the speakers with a few interesting lines of the work that they've done. Can I invite on stage Pawan Chaudhary? Now, for all us, Pawan, please. And what I did was, as part of this research that Gemini did for me, I asked it to find interesting quotes from our speakers from across public media. And Pawan believes that quant methods can unlock next-gen opportunities for family officers and advisors. And this is especially relevant because he's been successfully able to use quant strategies within the family office space. And this is a theme that, again, I get to see around the world, where family offices are increasingly looking at, I won't go so far as to say removing the human element from the decision-making, but augmenting it with quant systems. So, Pawan, thank you so much for your perspective. Can I also invite Shekhar Mehta? Shekhar? Oh, you have the, so you know, obviously, their names, etc. Should we make a rule, and this is, should we make a rule for speakers to sit under their photographs so that we know who's who? But thank you, Shekhar. So Shekhar's a very interesting line that says, Shekhar advocates robust, risk-aware decision-making frameworks. And risk-aware comes back to what Pankaj and Chris were talking about, the importance of paying attention to both systemic and market risk. And there are so many layers that we can unpack out of this. And I think there's a lot to be said about the work going on in that space. Natasha Adnani is our next speaker. Natasha, welcome. Natasha stresses on building resilient capital allocation frameworks for family wealth, using thematic and factor-based investing to endure across market cycles. Rishi Pradva made a very interesting comment. Rishi is the moderator for the day, and you know him well enough now, so I'll not talk about what Rishi said. But Rishi, you mentioned having begun your investment management journey in 2008, around the subprime crisis. And we both graduated around the time of the dot-com bust. So for all the young faces here, backtesting needs to extend beyond that. But also it's important to know that the behavior, the panic, the fear is packed in the price. But it needs to be felt personally to understand how to cope with it. So on that note, Rishi, I'll pass the stage over to you. Thank you so much once again.
Thanks, Joel. Yeah, so we have a very interesting panel discussion to kick off all the major discussions. This one is relevance of quant for family offices and advisors. And as you can see, we have three amazing speakers from amazing family offices and advisory firms with great background. To begin with, to set the context, yeah, one by one, first, I would ask each of you to share a little bit about how you and your firm are using data and quant currently for overall asset allocation, as well as for equity portfolios, and how has this broadly evolved over time. Just a quick high level if you can share before we go into more details. Shekhar, we can start with you.
Hi, am I audible? Am I audible? Yeah. Great, thanks. So just to give you a context, we are a large corpus of monies based out of India, Premji Invest. The largest LP is a foundation. Also our LP is Premji family office. So in that sense, what we are geared towards is a sustained long-term return with a reasonable amount of risk, and a set of given objectives that are conducive to that of the endowment. So in that context, we set our asset allocation strategies. To the question that Rishi, you asked, is that how do we end up using the broad word quant into asset allocation strategies to begin with? It actually starts with what is the eventual goal of doing all this. It has to start from there. then you can percolate it in many ways. One of the ways I just give you as an example is once you have the goal defined, which in itself is a non-trivial task, by the way. So, for example, if you were given X amount of money, let's say a few $1 billion, what is your goal with it, right? What the naive goal is return maximization. You earn as much as you can where you can. So that has an issue, and the issue is it is not sustainable. So, but if you want sustained growth, you need to have a strategy. That's where you begin with. Then the question is, how do you implement that strategy? What is your return target? What is your risk tolerance? Those are need to be defined first. And the definition of that, in my opinion, in my experience, is the most non-trivial thing. Let's say that you have some semblance of what is your return target and what is your risk appetite. Now, there are 1,000 ways to implement it. One of the ways would be to think about, for example, I'll be speaking in an Indian context. One of the ways to look it out is what kind of liquid assets are we talking about, or what kind of illiquid assets are we talking about? The bifurcation into liquid and illiquid then depends upon, again, your risk appetite, what are your liquidity needs, how fast can you deploy money, how large are the private markets to begin with. For long-term, taxation is a big deal. I think Natasha will be talking more about taxation than maybe, right? So it's a big deal. You want to maximize that bit of an alpha. In addition, I guess, once you have decided into what is liquid and what is illiquid, then you try to think about where do I maximize my risk and return. You try to figure out where your strengths are. How do you create a diversified portfolio? In the longer run, you need to understand that sustainability does imply that you might not be in the most highest yielding equity asset classes all the time, right? We spoke about the general philosophies of ruin, the general philosophies of uncertainties, but in a way, Quant helps us to define that. What exactly do you mean by ruin? What exactly do you mean by uncertainty? So in the context of longer term risk management, you intend to quantify these things as an investment assist tool, and therefore get a better understanding of what happens when you have to make the repeated decision of investing over and over again over a long period of time, and what sustains. Let me maybe stop there, and if there is anything.
Sure. We have a lot of questions and discussions to do, so we'll be covering a lot of things that Shekhar alluded to in the discussion. Natasha, if you can.
So maybe just a quick background of who I am and where I'm from. I'm from Mr. NSR's office, which is NS Raghavan. He was one of the co-founders of Infosys and one of the first co-founders, I think, to exit back in 2000. So at the family office, we've been in existence for about 25 years now in India. And soon after, we actually set up a presence in Singapore, right? The second generation is predominantly based outside of India. So that was one of the key reasons where right from the last 20, 22 years, we have been kind of distributing the wealth slowly and steadily from India to offshore, building an offshore capital base, right? So today we manage two pools of capital. One is in India and one is an offshore pool of capital that we look into as well. And so just a perspective of how global looks versus India, I know we'll get into details later, but how we look at both these portfolios and how do quants broadly, as the term is being used, fits in, right? Like Shekhar rightly pointed, quants can be utilized in various manners in your portfolio. It can act as guardrails, it can act as strategies, it can act, it's sort of a tool to deliver what you want to achieve out of the portfolio, right? But specifically to talk about strategies and how we approach quantitative sort of methods in portfolio construction, you can use that in various ways, I think, right? One of them being, it can be a very diversified source of return. So, of course, you have your typical asset classes, which is your equities and fixed income. But if you want to add an edge or a diversification and provide returns from other sources, then you can use quantitative strategies, which a lot of hedge funds do provide, maybe more in the global market sense, more than India. But it can serve as a diversified source of return. Another way that you can look at it, and which is the most predominant way, I think, would be it acts as a defensive play in the portfolio, right? It gives you that little bit of cushion vis-a-vis the traditional markets that you're invested in, and helps, in the volatility and the downturns when that does happen. And another, of course, corollary to that is that it serves as an uncorrelated source of return, right? Uncorrelated from traditional markets of investing. Another way that you can look at it is, of course, growth. You can look at strategies within quants to generate alpha, which is what a lot of what we try and do in India, right? When you look at long-short strategies or other strategies, even factor-based investing, they're more growth-oriented and alpha-generating oriented rather than the others. But yeah, broadly, these are just the various ways in which you can use these strategies to have a certain role in the portfolio. How we look at it is, that typical defensive, uncorrelated source of return, given that we are fairly largely long-term investors, largely allocated to equity and growth capital. This needs to play that cushion or that layer for us that protects us from volatility risk, from major drawdowns and things like that, right? So it sits in that uncorrelative defensive nature in our portfolio. We can deep dive into the strategies maybe later.
Sure. Over to Pawan.
Thank you. Very good morning, all of you. I represent Neo here. I steer investments at Neo Wealth. So if I understand the question, how are we using Quant at Neo to improve risk-adjusted returns for our clients? So I'll take a couple of minutes here. One of the important investment decisions that we make is our outlook on equity markets. And broadly, there are two purposes why we say that this is a very important decision for us. So we have, let's say, fully invested portfolios. And when we are neutral on markets, obviously we advise our clients to follow their policy allocation. And when we are overweight, we advise them to increase their equity allocation. And when we are underweight, we advise them to obviously decrease their equity allocation below policy allocation. Similarly, we are in a business of investing every day. So there are fully invested portfolios, and then there are portfolios where we are investing for clients in equity markets. So at all times, we have to decide, and we have to be very clear on the outlook on equity markets. So how do we do it at Neo is the question, and I'll use 2-3 slides to answer this question. And before this, if we go back to the slide, please. So friends, we all know that equity returns are the function of broadly two things. I'm not going into the theoretical details of CAPM and all, but if you look at equity markets, return comes from earnings growth and multiple re-rating or de-rating, right? And I'm discussing the thought process here before I discuss the multi-factor model or multi-factor investment framework that we have built at Neo. And before that, I built it at Client Associates to share how we are using Quant to come up with our outlook. So if you look at markets, Indian markets in the last 20, 30 years or global markets, broadly here, you are looking at 3 different buckets. The first one is neutral. And if you closely observe markets and valuations that we pay, they are the outcomes of 3 different cycles: economic cycle, interest rate cycle, and earning cycle. And I'll briefly explain what I mean to say. For example, you have an economic cycle. India should grow at about 6.5%. That's the potential growth for India. Inflation should be at about 4.5%, which means repo rate should be about 5.5%, which means 10-year GSEC should trade at about 6.5%. Earning growth should be about 12-13% at the index level. So if you have a normalized GDP growth, neutral monetary policy, normalized interest rates, and normalized EPS growth of about 12-13%, Nifty 50 normally should trade at about 21-year forward P, which is in line with historical averages. Which means you should expect normalized returns from market, which is your 12 to 14% return from Nifty. So that's the neutral zone for us. But from time to time, these cycles, economic cycle, interest rate cycle, and earning cycle, they dislocate from mean. For example, COVID hit us. Our GDP contracted. valuations became attractive. To revive economy, obviously, interest rates, the monetary policy became accommodative. So that was the zone where we say we go overweight on markets and vice versa. For example, heating economy, high inflation, restrictive monetary policy, expensive valuations, small cap outperforming large cap, value outperforming quality, lot of P data, turnover, make a case for underweight for us. And vice versa. So accommodative policy, GDP growth below the potential level, earning growth below the potential level, attractive valuation, no liquidity in the market, make a case to go overweight on the markets. And rest of the time periods, we are neutral. Just to very briefly discuss next slide, we have codified this framework. Here I won't discuss all the factors and sub-factors, but I'll summarize that there are 5 factors and 16 sub-factors and maybe 100 indicators. Combining economic cycle, earning cycle, valuation and others to come up with a score which is mapped to one of the stances, which could be from overweight plus to overweight to neutral to underweight and underweight plus. So that's how we are using Quant to come up with the outlook on Indian equity markets. By the way, I built this framework at Client Associates in 2016. If you can go to the next slide. And this is the track record of this framework, basis which December 2017 we were underweight on markets, December 2021 we were underweight on the markets, and rest of the years I just don't want to go in detail, but it has already established a very credible track record of navigating the markets across 2 business cycles in the last 8-9 years. So that's very briefly I wanted to share.
Thanks, Pawan, for taking us through that framework. Pretty interesting framework, especially since it's combining a lot of different things from fundamentals, valuations, macro, etc., which is not always easy from a quant perspective. Moving on, again, question for all panelists, but we could start with Natasha. I mean, what kind of quant strategies have you invested in India as well as globally? And I mean, if you have to measure the positive or negative impact of such strategies on your portfolio long-term objectives, as you mentioned, that is the primary objective, then, how do you really measure it? Are there any specific metrics, some specific data analysis, at a high level? It'll be very interesting for the audience to know. And a little bit about local versus global, obviously when you've experienced strategies live, how that local versus global flavor is very different, which you were alluding to earlier.
Yeah. Maybe I'll start with the last question first. That could lead into what we do in both our portfolios. But just landscaping how the global sort of space looks compared to India and what we have over here, right? One, I think, which is evident is the maturity of the market, right? When you look at the global landscape, predominantly US, but also the other developed markets, the depth of the market, the liquidity that you have over there, the availability of data, kind of the efficiency and that maturity is fairly large. You mentioned this as well, Rishi, that we're at the tip of the iceberg, right? So that's very, evident when you look at Indian market versus global markets. The second point being that kind of comes up from here, maturity as well, but it's the strategy breadth and underlying asset classes, right? When you look at sort of strategies that are available in India, of course, we have factor investing, we have smart beta strategies, there are absolute return, long short funds, a bunch of these that do come in and use quantitative strategies underlying. But when you look at it globally, there are many more asset classes that get covered, which just because of lack of depth and data availability in India is not possible, right? You can do fixed income arbitrage, there are distressed opportunities, there is global macro, multi-strat funds, there are like the depth of the market over there and the kind of strategies that you can deploy in your portfolio is far wide compared to what is available in India. So that's a vast difference. And the third one being, of course, talent pool, right? Whether you want to run this directly within your organization, build a prop desk, or whether you want to do this via managers, which is what we do. We do predominantly all our investments through managers. We don't really take on any single positions ourselves. But whether you look at it direct or through managers, I think the availability of talent, the availability of managers, is much, much more offshore, where you can actually, define, you want to go for top quartile managers, how do you get access to them? So you can actually look at it in that manner, compared to a handful that is probably available in India. So the choice over here is much more limited. And that kind of feeds into your portfolio construction, right? So leading that on to what we do in our offshore dollar-based portfolio predominantly is, we've built an allocation of this, which we call sort of the diversifiers allocation towards these strategies, where we look at building a good solid core, which would probably be, somewhere around a global macro strategy or a multi-strategy manager. Bring 2 or 3 of those in and build a core portfolio around that. And then bring in satellite or tactical allocations, which could be thematic, which could be opportunistic based. You can look at fixed income arbitrage, you can look at credit opportunities, distressed opportunities, depending on what is available in the market. You can build those tactical or satellite allocations around your core managers. So that is how we look at it in our dollar portfolio. In India, we've been largely doing this via factor-based investing. Right, so we've done that for, I think, about 2 to 3 years now, where we've our passive exposure. We've done this mainly passively, though now there are a lot of active quant funds that are doing this, and that's, it's worth a merit looking at them. But there's enough and more data that suggests that if you deploy capital using a little bit of factor strategy or smart beta involved, over the long period of time, these do have merit in the portfolio construction piece, right? And how do we measure these? I think, that's a difficult question to answer, because you would always look at back-tested data and kind of say whether this is a good way to build your portfolio, build your strategy in, right? And even as you're assessing it, of course, we do look at typical measures wherein, what sort of Sharpe ratio does this bring into the portfolio? How do we measure the volatility, the correlation within the portfolio with various asset classes? Is it generating substantial alpha, risk-adjusted returns, and things like that? But I think the right way to measure this is only over a number of cycles. For example, if you're a growth equity investor, right, you won't see value in these strategies in the next 2 years or 3 years or even 5 years. It's only when you go through multiple cycles is when you will realize your compounding is far larger when you have this cushion of uncorrelated returns or diversified returns built into a portfolio, rather than not. Because when you do go through these down cycles, it's important to minimize that downside to a large extent, and that plays a very far and wide role in the portfolio over a longish period of time rather than short. So I think to measure this, while we do use typical standard measures, but I think what it means is to wait and watch over even if it's 2 cycles or 3 cycles of investing, but to wait and watch how that does have a play. And of course, we've taken confidence in looking at back-tested data, but you will see that that does play out in the long period of time rather than seeing short or medium results out of these.
Great. Shekhar, next, if you could also, because you also have a global as well as local experience, and both sort of long-term, because you've managed that risk of the Hong Kong endowment as well. So, obviously same question, but yeah, if you could give a good context around local versus global.
Yeah, feel free to, it's a broad question, feel free to bring me back on track if I'm not on track.
Sure.
Right, so again, the way I think about it is, where you're using Quant, how is it used differently outside versus at home here? There are, essentially, when you look at long-term investors, you would see that their portfolios are largely biased towards equities. You're talking about north of 50% in equities, be it endowments, pension funds, family offices, and so on and so forth. So these long-term investors, this whole idea of diversification, which maybe everyone is sold in this room, not everyone is sold on it, right? If I need, I have a large drawdown, that's fine. Equity markets go up again. I'm a long-term investor, why do I care? I'll just sit it out, right? And it's a very, very plausible argument. The question is, why do you even bother doing all this quant, etc., for the long term if equity markets eventually go up? To that, I have two answers. One is more statistical. The other one is more philosophical. Let me start with the philosophical one, which essentially says that if you have any humility to the extent saying that you don't know everything about future, evolution teaches you to be prepared, right? Which therefore means do not necessarily run after the highest yielding asset at all times. Therefore means manage your drawdowns carefully. So that's your philosophical answer, I would say. Statistically speaking, again, there is a lot of work done here in terms of what works over a long period of time and what doesn't. And there is surely a level of volatility beyond which, if your portfolio is volatile, or pick up your favorite risk measure, whatever risky measure, there is a level beyond which, if your portfolio goes, coming back is difficult. In other words, what is called the probability of ruin is very high. So if you are a fiduciary, or even if you are an intergenerational planner, you have a duty towards making sure that you're not wiped out in most of the cases at a very high confidence level. And therefore, the need to quantify these kind of things. Now, why did I bring it in the context of India versus global? Partly because I think that we have been more equity oriented, also thanks to our taxation strategies, right? Sorry, taxes, right? So, but so to get anything, a juice beyond the risk-free rate, you essentially end up being in equities. But that said, there is a huge risk of this whole ruin. There is a huge risk of not being risk efficient. We can detail later what is risk efficient. So that's one angle. The other angle in terms of the kind of techniques that are being used, and Natasha, you already mentioned the various, and please feel free if you feel the urge of speaking something, because we're more or less looking at the same things. So some things that you mentioned is the various strategies that right? They provide you a different flavor of diversification. Now, again, any long-term investor is not diversifying for the sake of diversification. The question is, does your asset class have a different driver? Will you do good or bad, give me bad returns and good returns under different conditions? If you do so, your diversification is interesting to me, right? If you are into equities and equities by any other name, right, that's not diversification, even if you diversify across 100 names, right? So that's one sort of diversification. The other sort of diversification is the uncertainty of horizons. A longer horizon has a level of uncertainty. Let's say 5 years of a horizon has one kind of an uncertainty. There's a different kind of uncertainty at a 1 year horizon. There is a different kind of uncertainty at a 3 months horizon, at an intraday horizon. What you could do is to well incorporate each of these strategies into your allocation, right? You could have a part of your portfolio, as you mentioned, with, let's say, high frequency or lower frequency, let's say market neutral strategies or credit-based funds, etc., all the way to private equity, which, let's say, is a 5 to 7 year game. So there is a space for each of this. How do you fit these jigsaws in the puzzle is the asset allocation piece. But the need is where the quant has a responsibility to say that, you see, we are uncertain about the future. So most of the finance world is driven by people who are fairly confident. That's where some people have to say that, no, I don't know about the future, right? That's part of my career, more or less, right? Is to say that, no, I don't know. So what we do, therefore, is to build bands around our estimates. There is no escaping from prediction. One has to, if you're in the game, you have to predict. But what you could do is you could create bands around which, and then say that, okay, more or less in X to Y, I think the outcome should be there at a very large confidence level. So those are the kind of analysis again. In terms of, sorry, go ahead.
No, I was, you can complete, but
Yeah. So
I just wanted to plug in Pawan on an interesting thing related to this.
Sure, and just feel free to, we can go on and on. And actually, even from the audience, I'm okay if anyone has
Just want to share one thing, what Shekhar is alluding to. Basically, we all know Ray Dalio. When he started his career, he set up a fund. and he banked all his clients' money and his money on an economic scenario that was US recession, which did not turn out. He lost his money, he lost his clients' money, most of his employees left the firm. And then he restarted the firm with an idea that he would invest 25% in US ETF, equity ETF, 25% in gold, 25% in long duration bonds, 25% he would keep cash, and obviously, reallocate whenever the time arises for a particular asset class. And we all know what all-weather equity portfolio has done over the last 20 years. It has delivered S&P 500-like returns with probably 30% of the vol.
Yeah, the only difference, maybe just for the sake of an argument, I would say is that Bridgewater is brilliant. His risk parity is a cult in itself. However, if you look at the last 2010 to 2020 kind of a period, not that great of a performance. And I would say that the whole idea is that, do you understand why it is overperforming or underperforming? And to Bridgewater's credit, it effectively understands what it is overperforming and underperforming. So I guess the part that I'm trying to understand is that, and emphasize, is that quantitative techniques, and again, Bridgewater is again very well known for it, have been used as an investment assist tool, in a sense to say that if I need an objective basis on which I need to tweak, then what would that objective basis be? And that's the role most of the quant plays, other than the systematic trading, where there is no human. In the cases when we are doing a systematic trading, as a risk manager, I'm tuned to think of those systematic strategies as a trader. So every systematic strategy is a trader, and then can you have bounds around it, etc. And of course, there are backtesting strategies. Only word maybe on backtest that I might want to add is that backtest is difficult, even for the short term, right? Even for the short term, what do you backtest on? History, but history might not repeat. So what's the point backtesting, right? So good backtesting is difficult. That's one. The second thing I would say, backtesting becomes even more difficult as your horizon increases. How do I backtest a strategy that takes 10 years to happen, right? If I need to wait for, let's say, 5 years or 7 years for PE, a private equity fund, to mature, that means that I need to have at least around 100 to 200 years of history to do any reasonable backtest on it.
So on that point, yeah. So obviously there's a difference between short-term and long-term strategies. So as Shekhar correctly said, systematic, right, is short-term. Obviously you'll have much more data points there, right, depending on the frequency at which you are. And I know there are some HFT, MFT kind of guys in the room, not only long-only players, right? So obviously there's a lot more data the shorter the time horizon. And therefore, I think there's a lot more data on those backtests. So just to give a different flavor, obviously there are n number of issues on backtesting, so which we can go on for a couple of hours on that. But that's where I wanted to plug in Pawan actually, because Pawan, you've seen the evolution of hedge funds and some of these quant strategies in India as a wealth manager, advisor, and have been investing in some of these from the start, sort of seeded some of them as well. So from your perspective on this short-term versus long-term, would be good to get some inputs on how you view that. And secondly, also, I mean, when you're constructing it at an overall portfolio level, then what are the kind of metrics that you use? How do you decide which ones to do? How to weight it, right? So one thing I found is, again, the research that we all do, both from risk management side, which Shekhar alluded to, and also from a position sizing, weighting perspective, which I think all of us worry about. I mean, how do you manage all that within that context?
Sure. So hedge funds in India, if you look at, broadly we can divide them in two parts. I call them unorganized and organized. Unorganized, where quant traders are using multiple strategies in the SMA format, or they are managing their prop money like Graviton, etc. And then we have Cat 3 AIF. So in India, we have about 25 hedge funds managing about 20,000 crore. This space is evolving, and I am grateful, to see that this number is going to be a lakh crore in years to come. Now, what problem are they solving? I think is very, very important for us to understand. And how do we bucketize all these 25 hedge funds? Because there's a lot of confusion that I see when people talk about hedge funds in India. There are funds which are doing pure arbitrage. There are funds which are taking 30, 40, 50% equity exposure. There are funds which are taking 100% equity exposure. And all of them are bucketized in one bucket, which is absolute return fund or hedge fund. So it's very important to understand how these funds are bucketized and how we are using to solve 2 or 3 specific problems. Rishi is a veteran. I know one of the strategies I'll discuss, wall dispersion, he only started in India. But before that, I'll discuss how 25 funds are bucketized. So the first bucket is your debt plus offerings, or you can call them market neutral, low beta strategies. Idea is very clear that it is extremely difficult in India today to outperform inflation on a post-tax basis by investing in fixed deposit, debt mutual funds, bonds, because they are taxed at the marginal tax rate, especially for HNIs, right? So if you invest in FD and debt mutual funds, liquid funds, etc., your post-tax return is going to be 4.5% or 5%. So how do we outperform inflation on a post-tax basis is the problem statement. And the first bucket, which is debt plus strategies or market neutral, low beta strategies, this bucket is solving this problem. Now what this bucket is doing, there are about 16 funds which are managing 10,000 crore. So there are about 25 funds managing about 20,000 crore. In the first bucket, there are about 16 funds managing about 10,000 crore. Now, what strategies are they using? Again, we can divide strategies used by bucket 1 managers into 2 buckets, 2 parts. The first one is arbitrage strategies, because arbitrage is a very loosely used word in India. Arbitrage, cash and carry, we all understand, which most mutual fund managers do. But there is a strategy called index arbitrage. Future to future. Cash and carry we know. So future to future is that you buy, let's say, Nifty 50 future contract. You create a synthetic portfolio of Nifty 50 stocks, short sell all the individual companies in the same proportion and capture the spread. Then we have commodity arbitrage. Then we have box spread, which is one of the option strategies which is fully hedged. So there are a couple of arbitrage strategies which are used by funds to deliver 14 to 15% gross return, because returns are taxed at the marginal tax rate. In the AIF, they pay 39% tax. At the net of fee, net of taxes level, these funds deliver 7 to 8% post-tax return with monthly liquidity, and most months are positive without taking any interest rate risk, credit risk, equity risk, etc. So bucket A, there are about 16 funds managing 10,000 crore, doing arbitrage strategies and market neutral and low vol strategies. Within market neutral and low vol strategies, you have vol dispersion, which Rishi coined in India. Then you have, let's say, long short fund, which are not taking any market exposure, maybe 0% exposure or maybe 10% exposure. There's a famous strategy called BAB, which is betting against betas, that you build a long portfolio, which is a solid quality portfolio. You buy only companies which are throwing cash flows every year, ROE is high, etc. And you sell broken balance sheets and keep the net exposure 0, So I hope I am clear on the bucket A. There are multiple arbitrage and market neutral strategies, starting from index arbitrage to vol dispersion to long short to special situation. And thankfully, we see more such strategies in India to solve a specific problem to outperform inflation on a post-tax basis by delivering 7-8% net of fee, net of taxes return without taking liquidity, market, interest rate risk. The second bucket is called hybrid plus, wherein the manager takes 30 to 70% on equity exposure. Idea is to deliver equity-like returns with half of equity vol. There are 5 funds managing about 5,000 crore. Third bucket, which is very interesting, which is evolving, and Rishi also runs a fund. We also run 2 funds at NEO, one in the debt plus and the second one equity plus we launching. which is called equity plus. The idea is to outperform equity markets almost every quarter with slightly, risk which is slightly lower than equity. So these are the three buckets. 16 funds managing debt plus, 5 funds managing hybrid plus, 5-6 funds managing index plus strategies. They park money in index, ETF to mimic the market, and then they run multiple strategies, starting from long short to vol dispersion, etc. So that's how, this space has evolved in India from 2,000 crore in 2009 to 20,000 crore today. 25 strategies solving 3 specific problems, delivering debt plus, hybrid plus, and equity plus returns. So that's
Great.
how.
Yeah, that's interesting. So Natasha, sort of similar lines for you quickly. Obviously, this sort of diversification across strategies, and you mentioned interesting core and satellite approach and some tactical aspects on the satellite approach. So I think if you could flesh that out a little bit more on how sort of you would weight them. You mentioned non-correlation, how you use some of these sort of metrics to decide that sort of allocations, relative allocations in the portfolio. That will be a good flavor.
Sure. So, we do this predominantly first top down and then, bottom up kind of adds on to it. But essentially the diversification, which Shekhar was talking about, right? The driver behind the returns, that's got to be the essential root of diversification, right? So that becomes our first sort of driver in building out the portfolio. And that's how so when we talk about core as well as satellite, right? You look at core filling into your portfolio as being broadly diversified, which means it does not hold one particular risk or one particular bank on one particular sort of stream for return, right? So those kind of strategies fill into our core. And again, we look at global diversification. This is more on the offshore portfolio, but maybe I'll come into the India portfolio as well. And then satellite is, pretty much it runs around opportunistic sort of investment ideas that come in, thematic that come in. And these, when we talk about opportunistic and thematic from our end, we are fairly long-term investors. So even opportunistic for us is talking about 2 to 3 years and not anything anything below that.
But is there any market regime indicators or models or is it just opportunistic?
Yeah, it's mainly that, but we're starting to think about market regime indicators, especially in the onshore portfolio when we're looking at factor investing. So far our portfolio has been fairly static, barring a little bit of portfolio rebalancing. But I think this kind of comes into play, and that's why the active quant funds are playing a key role in kind of bringing in that regime monitoring and active rebalancing of the portfolio based on that. So I think that's where we kind of bring that into a play, but not otherwise, yeah. Because, with a very long-term objective, you, Shekhar also mentioned, you'll sit through the volatility, you will ride it because you're saying that you have a fairly long-term view. As long as you have that cushion when, it's necessary for distributions and drawdowns. If that can be taken care of, then, you tend to worry a little less.
Right. Maybe if I could add, it's kind of difficult to figure out, are we in regime X or regime Y? And there is a constant debate that happens with me, my PMs, etc. Is there a change in regime? So from a point of view of institutional capital management or asset management, it's imperative that we try and recognize it, right? But at the same time, I would be very, very, can come up with my own hidden Markov models or something that will tell me that there is a change, or maybe just stitch up some dates and see this graph looks like something.
No, else. I agree completely. So in the past, I've spent 1 year just doing research on this, and I agree completely with what you all are saying that it's not easy.
It's difficult to figure out that we are in a different regime. Yeah. However, taking cognizance of that is important, and having a discussion on that is important. And at the same time, it is the whole regime change thing is again not going to announce itself. If it comes in very subtly, right? So there are no good answers to what's the best idea to model these, at least in my head, to model these. But nonetheless,
and while you're speaking, Shekhar, also a little bit, we're running out of time, but I did want to touch upon, since you have been focused on risk side, as I said earlier, risk and this portfolio allocation is what is not researched too much in India. So any specific risk tools, metrics, methodologies, you mentioned risk of ruin, drawdowns, you and Natasha mentioned, what other things even at a high level for the audience you would like to highlight?
So yeah, I thought out at least, please feel free again, we can go for hours. So in the interest of time, it says 1 minute. Okay. So one of the things is, the workhorse of short-term risk management is geometric ground in motion, right? Everything stems from that. Volatility scaling with square root of t, right, of time, right? That's the workhorse. It works fantastically until 3 months. I mean, it just works beautifully, right? Any decent model that you want to pick up, EWMA models or filtered simulations or Gauge, not Gauge, the filtered simulation, whatever it is, right? It works just beautifully. The issue is that a diffusive model is wrong at long horizons. So it's completely wrong. As a result of which, what happens is that you tell your portfolio manager precisely at the wrong time, when the walls are looking high, that can you please do a risk off. And that is indeed if you had instead, for example, a mean reverting model, right? And mean reversion could be made sophisticated to the nth order. But if you do a mean reverting model in one shape or form, it is better than the diffusion model. That said, the mean reverting model is more complex and there is higher model risk in it that one has to acknowledge. What is the speed of reversion? What is the mean? And in a regime change, do the means change over time, right? So it's less trivial to do so. But then again, those are the kind of tools that one needs to employ if one is looking at long-term risk management as such. One of the other things that I must say is, and just, I'm not sure if I get more time on it, so I'll have to...
30 seconds.
Yeah. Is, maths, especially in the long run, has to start relying on trust. So your stakeholders should have some trust in you, else for the long run, and management of money in the long run, nobody listens to you. So that is an element that every quant has to build, irrespective of the horizon, but more for the longer horizon if one is looking at. I will stop there.
Yeah, thanks. No, so I think clearly all of the panelists here have a lot of experience in different ways and we can keep discussing this for hours and hours. They're here for a decent part of the day, so please feel free to interact with them, and we'll open the floor to questions in just a minute. But post that also, if there are any questions remaining, you can catch them offline and ask. Just before we head into the questions, very quick 10 seconds from each of you, since, again, this is an association event and first time in Bangalore, very quick thoughts, just think of it as a rapid fire that come to mind on how you would like to associate, support Laqsa, any high level advice for us as well. Please feel free to say anything for, start with Pawan.
Yeah, in fact, we have set up an in-house research lab, and we are more than happy to connect with Laqsa on multiple fronts, starting from training and development to building strategies together, to even hire people who are coming from this platform, to even support strategies. If you have a good strategy, there's no dearth of capital, so we can definitely engage on multiple fronts.
I think we can look at, I know there's a lot of work that's going on between yourself and Pankaj on this, but to kind of build that network, right, the global network, because the learnings from there are immense, right? There's a lot that you can take away from there. So I think, and we do have access to a few of the great managers out there, but so kind of taking away those learnings and bringing them to this forum, I think that would be key. So building that network with them, and bringing the learnings forward as well, that's something that we can collaborate on with Laqsa. Yeah.
Hey, if you could kind of keep it slightly more informal and, where people like us can come in and say, we are trying and struggling with AI, and maybe we can, learn a thing, something maybe basic, something intermediate, something advanced. At my firm, there is a dedicated effort towards integrating AI into investment decisions, but we feel lost at all points. We feel insecure, and but nonetheless, something that helps us navigate this is through a slightly more informal channel. I would appreciate it.
Great, thanks a ton for that. We'll quickly take 2 questions.
Yeah. There's question there.
So, hi sir, hi panelists. So, myself Rishit Hans. I am basically a 4th year's BB honors student. And basically my question was, you have mentioned about a lot of AIFs and a lot of risk mitigation strategies for options, futures, and a lot of strategies that that is basically used in quant finance. So recently there is something which is introduced which is known as SIF system, which has been introduced in India with SEBI regulations. And I just wanted to know, this is basically introduced to bridge the gap between mutual funds and PMS. So how could this basically shape up the financial industry or markets in India?
So I think, in the interest of time, I'm sure Pawan can easily share, everything around that with you, and so can I. But we'll take this offline in the interest of time. Any specific question related to what the panelists said, or any theoretical stuff you want to ask them, we'll just take that question.
So even Asnes says that sin a little but don't sin too much. To the question regarding the regime switching part. So you are just completely against switching regimes, or since Asnes also says he actively uses tilt the portfolio towards what is working. So what are your views on that? Should someone just actively tilt?
He has a lot of bad market cycles as well.
That's true.
So I can share my experience of regime. In fact, I completely agree with Shekhar that it's a futile exercise. So time it to the T, extremely difficult in hindsight, because the leading indicators, they change in every regime. But having said this, what I've seen across cycles, that even if you are early, it pays off well. For example, I give an example of Indian markets from 2014 to 17. If you closely monitor the markets, small cap at the size level and value at the style, these two factors outperformed quality and large cap. 18, 19, 20 was the time period for quality and large cap over small cap and value, and now from 22 to 24 first half, again value and small cap outperform, and now is the time for quality. So the model that we have been using, and we have seen that when economic activities are normalized or weak, when interest rates are low, and when the relative valuation between quality and value favors one of the verticals, eventually, market favors and delivers superior returns. But it's very difficult to time it to the T. But even if you are early, let's say towards the beginning of 2020, I wrote a note on why one should not invest in Marcellus. Saurav is a very good friend, by the way. But because every, fund, the money was just chasing quality stocks. And the valuations between the quality and value, and if you look at the quality as a segment, was 2 standard deviation more than the mean. And as Shekhar says, mean also changes over a period of time. But adjusting for everything, the valuations were very expensive. And economic cycle was favoring that particular regime that time. And we said the regime will change. Although it did not change in the first 6 months, but then eventually, it changed and it favored value stocks, etc. So just to conclude, it's very difficult to time it to the T, but if you can have a framework that even if you are early, the outcome matches your expectation, one could try this.
Could I just add a couple of things here? Pawan, I didn't intend to say that we should not be doing it. I don't know if that went out as that.
But it's difficult.
It's difficult, but I come from a philosophy which says all models are wrong, but some are useful, right? So in that sense, it is still a useful exercise to do. We must be aware of the regime we are in. Forecasting is even stepping back, cyclicality is different from a regime change, right? Cyclicality is one part of the model, regime change is another part of the model. Regime changes, cyclicality again is not that easy, but nonetheless, it's slightly more tractable in my opinion. Regime changes are abrupt. You need to maybe ex ante make your portfolio resilient to regime changes. And that's where diversification and portfolio constructions it becomes important. It is important to model and understand the regime. One of the things, for example, is high inflation regime prior to last 3 years was simply unavailable in regular data that you get from Bloomberg. I'm talking in the US context, right, in the last 10 odd years, right? So does it mean that we forget about it? No, there was a sudden regime change, right? Does it mean that you should never have tips in your portfolio? No, the answer was have some tips in your portfolio, for that matter. So the point I'm trying to make is that there is no, I didn't want to come out with this answer that there should not be I was just saying it's difficult in that sense. But it has to be an integral part of your investment decisioning process.
We're running out of time, so we'll wrap up. But yeah, as I said, offline, all of us are there, so we'll discuss. Before I let the panelists go, yeah, we would just like to give them a token of appreciation for joining us today.